Hello, hello, hello. I hope that you are doing very well today. This video today is to go over the review of the COVID-19 legislations that have come out as it pertains to individuals. There's been a lot of information out about businesses, and I figure that individuals need to know what is going on with the COVID-19 legislations and how it can benefit you. So let's get started. Of course, this is my disclaimer stating that any advice here should not be considered legal advice, and it's subject to change as everything is changing really fast with the legislations. It's almost hard to keep up. So this is my liability declaration. And if you want a copy of these slides, please feel free to email me. My email is on the first slide of this presentation. All right, and here I am. I go by Candy. My legal name is Candace, but I go by Candy. But this is the person who's talking behind the screen. All right, so let's get started. We're going to talk about the individual provisions that are for individuals, the economic impact payments, individual retirement accounts, and net operating loss. So let's get right in to the Coronavirus Aid Relief and Economic Security Act, called the CARES Act. All right, so the individual provisions are, first off, that most of you know, is that the personal income tax filing and payment dates have moved to July 15th of 2020. This also includes estimated tax payments that are due April 15th, 2020 as well. As always, if you need more time to file your taxes beyond July 15th, 2020, you can still file an extension by July 15th, 2020. And then you'll have until October 15th of 2020. Now, keep in mind, this is only an extension of time to file. If you owe money to the IRS, you will be assessed penalties and interest for late payment. So it is not an extension of time to pay, just an extension of time to file. State filing and payment deadlines are different. Then each state is different. So check with your state. I do have a list here that was current as of the other day. You can see Colorado is different. The District of Columbia was different as of when I made this video. Hawaii has a different date of July 20th. New Hampshire was still April 15th. The ones that I have are blank. I was not able to find the information on. The ones that are NA, they do not have state tax. And so those far are the only ones that I was able to point out. Like I said, these are subject to change, and they could change today for all that, for as far as that goes. Now let's talk about the economic impact payment that everybody is excited about. It is for U.S. residents that have a valid Social Security number. You can get up to $1,200 for an individual and $2,400 for married couples, up to $500 for each child that is a qualifying child that is listed on your 2018 or 2019 tax return. Payments are going to be based off of your 2019 tax return information, if it is filed by the time they start sending out the checks. If 2019 is not filed, the information from 2018 will be used. Now, there are phase-out limits. Once single taxpayers' income reaches $75,000, or married couples reach $150,000, and head of household taxpayers reach $112,500, there's going to be a reduction of $5 for each $100 of adjusted gross income over the relevant threshold. Now, then there is the limit where you're not eligible. And for single taxpayers of the adjusted gross income that is over $99,000, and married couples filing joint over $198,000 with no children are not eligible. Payments to those on Social Security are not required to file a tax return and will automatically receive payments. This one makes me very happy. There is nothing you need to do unless you need to file a 2018 or 2019 return and eligible even if you have a tax or tax filing obligation. This is a credit that is a credit that's going to be on our 2020 tax returns. So if you do not file for the credit now, my understanding is you'll get, or if you do not get the credit now because you didn't file your returns, you'll get the credit later when you file your 2020 returns. That's my understanding now. It could change at any moment, and that could not be right. All right, let's look at individual retirement accounts. Your contribution deadlines have also moved to July 15th, 2020. And an eligible individual may receive up to $100,000 before December 31st, 2020 from a qualified retirement plan or individual retirement account prior to the age 59 in house without liability for a 10% premature distribution penalty tax for a coronavirus-related distribution. Now let's go on, and I see that I spelled individual wrong. Excuse me on that. Unless the recipient elects otherwise, to the extent that the coronavirus distribution is required to be included in gross income, it will be included and taxed ratably over 3 taxable year period beginning with the taxable year of distribution. So what this is saying is that unless you choose to pay for the income tax on the amount that you withdraw in year 1, it's going to be prorated over 3 years, so you would not pay for the $100,000 income tax in year 1. You'd pay it over year 1, 2, and 3. Now, however, at any time during that 3-year period, you can pay back what you took it as distribution into that retirement account. The contributions at that point will be considered a rollover contribution by the IRS. They will not be subject to IRS income tax, and they also will not affect the amount of allowed contributions during those particular years. So basically, you're almost borrowing from your IRA. You borrow $100,000 up to $100,000 over a 3-year period. You pay back that $100,000 without any payments or repercussions from the IRS. Plus, you can continue to contribute to your IRAs, the normal contribution limits. So let's talk about what is a coronavirus-related distribution between January 1st and December 31st. It is eligible to an individual who is diagnosed with the virus SARS-CoV-2 or COVID-19 by a test must be approved by the Centers for Disease Control and Prevention. When your spouse or dependent is diagnosed by a Center for Disease Control test, or you experience adverse financial consequences as a result of being quarantined, furloughed, laid off, or having hours reduced due to such virus or disease, being able to work due to lack of child care due to such virus or disease, reducing hours of business owned or operated by the individual due to virus or disease, or other factors determined by the Secretary of Treasury or Secretary of the Delegate. So the plan administrator may rely upon employee certification that the employee satisfies the condition for determining whether a distribution is a coronavirus-related distribution. So that means that the plan administrator doesn't need to see your test or doesn't have to have any proof of the following recommendations. And coronaviruses-related distributions shall not be subject to withholding tax rules. That is good news. Now, there's additional provisions for IRAs, which I'm not going to go over with in this video. You have loans from qualified plans and temporary waiver of required minimum distribution rules. Those are 2 other provisions that are available for individuals during this time. Now, another wonderful item that has come back during this time is net operating losses. With the tax changes that happened in 2017, carrying your net operating losses back was discontinued. You could only carry your net operating losses forward. This is suspending that for just a little while. So net operating losses that arise in the tax years 2018, 2019, or 2020 may be carried back for 5 years. And they're doing this so that if you are in need of money and let's say you had a net operating loss in 2018 that you carried forward when you could have carried it back, well, go back and amend 2018. Carry it back. And then do the same, let's say you have one in 2019. Go back and amend your returns and get the reward of your net operating loss now while you need the money. And it also removes the 80% of the taxable income limitation retroactively so that net operating losses can fully offset taxable income in 2018, 2019, and 2020, regardless of the year in which they arose. 80% rule goes back into effect for 2021. So it's important if you had net operating losses in 18, 19, or you have one in 20, you can carry those losses back. Keep that in mind, but because they will go away in 2021. The bill does not change the rules for capital losses, which can be carried back 3 years and forward 5. So that doesn't change. And there are exceptions to this provision, of course, but we're not going to go over all of those. So if you have any questions about any of this information that I gave to you, or you would like a copy of these slides, please email me at info@numbercruncherllc.tax. Now, I've been telling all my clients this. I'm going to tell you this. Stay positive. Together we will get through this. Thank you for listening, and you have yourself a happy day. Goodbye.